Okay, sorry about that. So, in relation to the question here, I'm going to take this part first. When opening the married put, setting a somewhat arbitrary goal to exit at X profit or Y at time limit. This is discussed in the blueprint. In the first chapters of setting up an RPM, we talk about number one, setting your own personal goals for the position. Now, although hundreds of users, multiple hundreds of blueprint owners out there are trading this technique, myself and Ernie trade this technique, we all might have slightly different goals. And John and everyone else who's using this technique, for this limited risk strategy, you might have heard me say that my target is usually around 1 to 1.5% for every 30 days I'm in the trade. Okay, I know I'm giving some up to the put option, but that's also so if I do have a stock that falls 10 or 15%, I'm not risking more than 4 or 5% on the position in the worst case scenario. Now, this doesn't mean that I'm going to try to force a sale of a call against the married put structure if it's not the right time. This doesn't mean via income method. In the first 20 to 40 days, I want to see that the stock has moved up maybe at least 1 to 1.5%. It can be an unrealized return, but that means it is moving in my direction. Okay. Would I exit at what profit? Well, if I'm in the position for 2 to 3 months and I'm at 4.5 to 5% gain, I've met 50% of my goals for the trade in half the time that I might have the put out in time, that might be the exit. Would I do it after 1 or 2 months? Probably not. So I have a target here of 1 to 1.5%. Let's say the stock moves up 5% in the first 60 days. Well, that's exceeding my expectations, and in addition to that, it's going in the exact right direction I want, and I've probably done 1 or 2 income methods already with this increase in the first 60 days and put my married put in a better position. Probably cut the risk in half, if not bulletproof the position, and also generated some income against it as well. This 20 to 40 days is not arbitrary. That is also talked about in the blueprint. That's sort of the checkpoint. If I open a married put and it has not done what I've expected in the first 20 to 40 days, and I feel my sentiment has changed on the position, I'm no longer as bullish on the market or on this particular security that I was 30 to 40 days ago, I might exit the position at that point, take a risk of only 1, maybe 1.5, maybe 2% due to some of the time value decay on the put option, maybe a little bit of decline on the stock, and then move on to something that looks stronger. Okay, so 20 to 40 days in, evaluate your married put position. Are you achieving the goals you've set for yourself for the strategy? Are there opportunities to do any income methods that are available? If it hasn't met your expectations in the first 20 to 40 days, but you have an event coming up, such as maybe an earnings date or a dividend within the next 20 days after, you might want to stay in the position. If you have no earnings coming up, you don't see any opportunities to do any income methods, you haven't met your goals in the first 20, 40 days, and you don't feel strongly about the stock, you might want to consider exiting the position. Now, Sam brings up a point here, and this is the information that I'm giving you can also be applied to other strategies. If you're trading spreads that are, say, 2 weeks out, rather than do 20 to 40 days, just do maybe half the time for the spread. If you're doing a straddle position where you're buying calls and puts that are 3 to 4 months out in time or 2 to 3 months out in time, halfway into that period, check to see where you are. This goes to Sam's comment. He says, in options, I like to take 30 to 50% or more profits and stocks at 10%. That's a good exit rule. Okay? But it's not really what I'm looking for here with the married put, and Sam knows that because we don't have a calculated max profit. We have an infinite upside and a controlled risk. And in this strategy, as I mentioned, my goal is 1 to 1.5%. If in 15 days I took Sam's rule and the stock was up 1% and I was making 0.6 or 0.7% on the married put, I don't think I would close the position at that point because it's going in the direction I want and I want to look for further upside. Okay, so this is some basic guidelines. This 20 to 40 days after you open a married put is your first checkpoint. And the halfway point in any strategy that you're trading, whether you're doing weeklies, whether you're doing diagonal spreads, whether you're buying straddles, selling straddles, or selling strangles, the halfway point is always a good check mark. Yes, with a married put, I might be 8 or 9 months out, but that first 20 to 40 days, I want to make sure that the stock is doing what I originally expected and matched my expectations. Okay, now, going further with that, for those of you that own the blueprint, this information is already there. There is a full chapter on exiting the RPM. At the end of that chapter, there are several bullet points that discuss ideas for when to exit position. It highlights naturally some of the things I just mentioned. Closing the married put. If I bought an 8-month out put and I'm within 60 days to expiration of the put, I've held it for 6 months, I'm within 60 days, I have to consider closing or extending it, because what's going to happen is that time value that remains is just going to decay out, and I'm not going to have a good position anymore. If my goals are not being met, and we talked about that, set your goals for the position, look at it based on a monthly basis, and if the stock is not meeting the goals you've set for it, you might want to reconsider. If there is a decline from a recent event, maybe even market weakness, some bad news came out for the industry or for your particular stock, and your sentiment has changed on the stock, you're no longer bullish, you could evaluate an income method to profit to the downside that's discussed in the blueprint, or you could decide just to close the position, take your small loss, move into something else as well. The goal is not to take the full loss on the position, even though it's limited to 5 or 6%. I just don't want to hold that all the time, okay? Yeah, so set your goals, John. They don't have to be my goals of 1 and 1.5% every 30 days, either unrealized with the stock movement or realized with the income methods, but set the goals you want and then check them at those defined markers as well. Now, I put here on this slide, I put the NRG example in here, closing if you're within 60 days. I'm not within 60 days to the expiration of the put on the NRG position, but I am going to show you some ideas that I have to consider, and I considered 12 to 15 days ago as well. Okay, so we're going to use NRG. It's a married put position. As in my trading account, it was posted into the Fusion subscribers when I opened the position about 70 days ago. And we're going to take a look at that first as some ideas of what could or could not be done to kind of show you my thought process. And it's the same thought process I would apply to really any other type of strategy. A collar, a diagonal spread, a bull put spread that still has 5 to 8 days to go. One of the straddles that Sam's talking about possibly as well. All right, so I'm going to navigate over to the PowerOptions suite of tools. All right, there we go. And we're going to jump right into the portfolio tools here. We're going to take the radioactive trading positions, and here is NRG. Opened it on December 18th. Just sort of at the end of that decline that we saw in December. It was around the 26th or 27th when it started to recover, and market's been moving up good since then. I think I got in maybe a little bit too soon. In any case, just go over the numbers real quick and then we'll look at the graph. Bought the stock at 41.35. Bought a January 2020 45 put for $6.90. At the time, it was 395 days out in time. The stock is up 2.1%. Though that's close to 1% every 20 to 40 days, right? I'm up 2% in 73 days. Haven't done an adjustment on this yet, but let's take a look at what happened. So let's go to the profit and loss chart. Sorry, folks. This position, there we go, has a limited risk of only 6.7%. I remember when I opened it, that was 397 days. I'm not there yet. Okay, I've got a small loss on the position. I'm sorry, let me see what we've got there. The small loss on the position right now of only 1.3%. The stock's up 2%. Why am I losing money? Because it's been 2 months. So I've lost time decay on the put, even though the stock has been moving up slightly. All right, so this is now kind of doing what I want, but it was questionable for a while. What do I mean by questionable? Let's take a look at big charts very, very quickly. Let's go to a 3-month chart. Okay, fantastic. So here's that sort of December lull, and then it started to come back up. And you see it was doing what I wanted into January. I want you to keep this in mind, John. First 20 to 40 days, got in right around here, took this hit. Okay, well the stock started to come back up, showed some hesitation, but here, roughly 20 to 40 days in, stock is flirting with 42, so I'm near that 1% gain. And I figured, okay, it's been trending up. This was due to the market, not the stock. That was a horrible December. It was due to market conditions, not the stock. I'm still comfortable staying in it. I'm near my 1%. That's good. It's doing what I want. And then it took a hit. Okay, so that started to come back up, and now 20 to 40 days in, the next 20 to 40 days for my first checkpoint, here we are at about 60 days in, it's up to 43. What is it doing? It's doing what I wanted, right? Yes, it's up 2 points. It's up from where we got in, I'm sorry, 41.35. It's up almost 2 points. It's at the percentage I'd want for 2 months, and then it does this again. So I'm very cyclical with this stock. It's right about where I got in, a little bit above. You saw that as that a 2% gain for 73 days in. It's underachieving. This was my fault for trade entry, bad timing. It recovered, took a hit, recovered, was doing what I want, and then it took another hit again. So now I have to worry about if it takes another hit, I'm not going to be meeting my expectations. Only 2% up on the stock, 73 days in, and I'm losing on the put, as you saw. So now I have to analyze, what can I do? Well, there are some things I could do in this scenario to lower the potential risk I'm taking on the trade. So for example here, remember, I'm out to January, and this still has a lot of time value remaining. So because I opened it far out in time, I have the choice to consider cutting down some of this risk, not realizing a profit yet, but maybe cutting down some of this risk. If I sell that January 45, it's about 540. So we've got smaller time value than we started with, but we still got some time value remaining on the put. I could move it into June, cut it down by about 1/3 of the time. Now I could keep the same strike or lower it. So I'm going to keep the same strike first. So you see here, this is going to be about 380. We're going to get about 540. So I'm going to lower my risk by $1.60. I'm shrinking the amount of time I have in protection, of course. But by doing this adjustment, selling at the midpoint at 540, buying at 380, I cut the risk only down to 3.5%. I still have 112 days to go. Have I turned this from a loss into a profit? No. But I've made an adjustment here that cuts my risk down almost by half. It does shorten the time frame, but now with the fluctuations, I know that in the worst case scenario, even though I'm losing, even though I'm losing 1.3% now, and this is more than double that, the maximum risk, is that if the stock does continue up to 43, I can start making adjustments on this trade, and I only have to reduce it by 165. Another factor that might lead me to determine this movement on the stock that's stagnating, not performing to my expectations for this longer-term limited risk position, is let me go to the stock research tool real quick. Let's see, the last earnings I've already crossed, and that helped with the 2%. That's why I didn't close it the last time, because earnings were coming up in 30 days on February 28th. It had some effect on it to recover from the last pullback, and it's still doing some increasing for me in the direction that I want. So I could choose to do nothing on this underperforming position, not quite meeting my goals, or I could do something here that even though the stock is stagnating, I could cut the risk in half, although I do shorten the time of insurance as well. But this one is moving in my direction. If my sentiment has changed and the earnings were poor and it looked like energy was still declining, at this point, John, I might just exit this Mary put together. take maybe a 2% loss for 60 days, I'm okay with that. I'll go look at the other positions, other opportunities, take the small 2% loss I made here, put it into another stock from the search list that matches the trend I'm looking for and the goals that I want. Okay, so that's one of the examples I wanted to show you. As we talked about here, poor timing, it was down to 36, 37. I stayed in it because it began to recover. First 30 to 40 days in, the first check mark, it was sort of getting to where I wanted to. It was in that gain of almost 1%. Took a little hit, started to come back up, and this decline here going into the earnings, you know, that always happens. And then we had a nice pop up and some pullback, and then we're still going strong here as well. Okay, so it was the other day was the earnings on energy. That's why I didn't do anything, so I was waiting to see. If it dropped here, let's say to 39 the other day, I probably would have exited this RPM today, but it didn't. It didn't necessarily have a great positive. It had a great spike, little pullback, little reaction, settled, and then today it moved back up. So it's going in the direction I want. Not sure, I don't want to exit it right now because it is recovering, even though it is just shy of my goals. But again, I'm near the point where it's going to where I want. And on that, Sam says, looks like 43 is resistant area. The stock is not going higher than that. And that's a possibility. So when it does hit 43, in addition to doing an adjustment here, Sam, on NRG to generate income and lower the cost basis, I may actually put on a position similar to a strangle as do an adjustment similar to create a straddle or strangle position. So if it does pull back from there, I'm going to use that extra protection as profit to further lower the risk as well. 43, 43.50 is about my target to consider that, depending on when it hits it and how it hits it. So, but you're right. It does look like a resistance point, and that's a consideration I have to do as well. Okay. All right. So let's see here. Okay, so that's just what I wanted to comment. And John, again, last time, remember to review that exiting the RPM chapter in your blueprint. There's several bullet points you'll see there on when and how to consider managing or exiting the married put based on timing, as your question asked, based on pricing, technicals and fundamentals as well, but consider that 20 to 40-day checkpoint is your time frame. In other strategies you might be trading, consider it the halfway point. If you're trading positions that are 20 days out, 10 days in, check to see where you are on a covered call, let's say, an out of the money naked put, maybe a vertical spread or a diagonal spread, and halfway to the short-term expiration as well as sort of a checkpoint. And then, of course, I'd also have my alert set in the portfolio. If it falls too far, it moves up to my trigger point to do an income method. I have that already set in the portfolio to alert me as well. All right, let's see here. All right. Yeah, Sam, I haven't seen the profit I want yet to do sell a 45 call on NRG as a covered call to create the collar in that married put, so I haven't sold the call yet. Sam has gotten good this week with earning straddles in Roku and Etsy. Both were pretty good. I believe Roku was good. Maybe Roku was the decliner. And you followed Tandem up and then got out after the earnings and then, okay, yep, and got out today. All right. Okay, and then some other positions on Tandem and BPTH. I don't know that one. Had a question come in related to that. This is, how can I find the upcoming earnings events? Well, on PowerOptions, we have these pods that you can select, these sort of data pods, market sentiments, the power watch list, the market activity up here. It's all listed on the main homepage, upcoming webinars, and top stock gainers, top stock losers. And most of these you see in the top stock gainers, of course, are going to be due to earnings one direction or the other. PBY, Puma, okay, biotech, that might not be related to earnings. Globalscape, LXRX. When you see a pharmaceutical on here, it could be related to earnings, but it could also probably be related to a phase 2 or phase 3 drug trial. In any case, you see over here, one of the other pods we have are the earnings announced today, X-ray, WX, WBP. But if I click this link that says view more earnings announcements, that's just going to take us to a page that shows us what's coming up soon. Foot Locker was today as well, before the market. Let's see here. We can go to the next page. Oh, these are all for today. So coming up next week, what do we have? Claris, Sandridge, Biocyst Pharmaceuticals, Adams. I'm looking for something. C-Trip is kind of known. Atlas Financial Holdings. I want to see what's big coming up. Sienna, that's a big one coming up. March 5th. Eagle Bulk Shipping, used to trade that one. Let's see here. Anyway, so you can access this and scroll through. You can see which ones. You can also run a search anytime to look for straddles or strangles or positions that you have, for earnings coming up in the next 3 days, next 5 days, next 7 days as well. Let's see here. Lumber Liquidators, March 5th. Green Sky, Ambarella. Let's see, anything else stands out? Okay, no, nothing really big other that stands out. Vivint Solar maybe. Kohl's, okay, Kohl's is in there too. They're the same day as Lumber Liquidators, both before market. Okay. All right, so that's what we can expect coming out next week. So that's what you can do. You can just add the pod there, and then earnings announced today, and then you can quickly click here to see more earnings coming up if you're planning on making a trade there. Oh, Foot Locker had a 7-point drop. Okay. And you got out of the 64 puts. Okay. All right. Okay, good. Let's just take Foot Locker real quick. So that had earnings today, of course. Sam had just mentioned that it had dropped from 69 to 62 before that. And then it recovered here a little bit today. So we take a look at the chart. Lots of fun on that stock, I guess. Okay, no. So it was hovering. Yeah, I see what you're saying. It gapped up at the open to 69 and then pulled down to as low as 62 and then recovered down about 63. Okay, huge gap there. That's what you were saying. I apologize. I missed that. Okay, so that was a one-day gap. It almost went up to 69. The high is 68-ish or so shown today, and the low is 62.03. So nice bounce around to 6 points there. Probably heavy trading into the day, but it looks like they had positive earnings. I'm sorry, I thought you had said it had fallen, then it had moved back up. My apologies, misread that. Okay. All right, let's see here. So that sort of covers what we wanted to talk about with the married puts, the exiting ideas, which also apply to other strategies. And remember, as you're tracking any position in the PowerOptions portfolios, you can set the variety of alerts here if the stock hits a target price, or if the stock's trading above a 50-day moving average or drops below a 50-day moving average. Let's just take the T-Rex married put here. So I've set an upper limit at 79.50. Why do I have a red warning of an upper limit of 79.50 on a married put position? Because I sold the 80 call. So that's my trigger point to roll that 80 call or adjust it if T-Rex suddenly starts moving up there. I don't want to let it get in the money. So I set this upper stock limit and I set it as a warning because I need to move it. If it was profit where I might do an income method, I would have marked it at green. Okay, all right. So going down here, I'm sorry, you can set the different stock alert limits if the stock price drops above the SMA 20, 50, or let's say if the 20 drops below the 50 or the 50 drops below the 100, showing weakness if you're in a bullish strategy. Days remaining until earnings, ex-dividend, lower Bollinger Bands, total position change, and more. So you can set those alerts, and if you're on the 20-minute delayed subscription service or higher, of course, you can have those alerts emailed to you whenever they're triggered. And that works for any strategy. If you're just buying calls or buying puts, you're in a covered call, an iron condor, butterfly, you can set the various alerts for the different legs of the options, the total position itself, or the underlying stock price if you wanted to have an upper and lower trigger, as I probably would with an iron condor or a butterfly as well. Okay, let's see here. I also talked about all of Sam's comments there regarding the TBTH's tandem position as well. Rolled that up to about 53 and then got back in at 65 on tandem, TNDM. I think that's tandem. Question comes in from, is it Mike? Oh, it's Mitch. I'm sorry. Question comes in from Mitch. Mitch asks, is there a way to look for high option volume or activity? Absolutely. Okay. In most strategies, and especially in the single option strategies, which means, just one leg, one option leg, a covered call, naked put, but more specifically, buying a call or buying a put, you can screen specifically for increased percentage option volume. I don't have long calls here, so let me go into the Other Strategies tab. Here we see our available strategies, the 23 plus available strategies I mentioned. I'm going to take out long strangle for the time being, and I'm going to add long call from our available menu. Let's just go ahead and save that. Okay, Mitch, so what I want to do here is I'm going to go to long call, and I'm going to go into the search. And this just gives me the basic results here. This is from one of our default settings, the Bollinger Bands that Ernie structured. And of course, in PowerOptions, the available criteria you have, expiration time frame, implied volatility, ratios and ranges, in or out of the money, probabilities, bid-ask spread, Black-Scholes ratios, percent to double, we touched on that last week, delta, of course. And then we have our liquidity section. And we see here we have option volume today is a total number of contracts traded today, the open interest, and then we have previous option volume, percent previous option volume, and the percent current option volume. This is today's total option volume across the entire stock security. You don't want to focus on one strike. You want to look at the entire stock compared to its 30-day average volume. Okay, if you're doing it today, if I was doing it during the day, it's adjusted for the time of the day. So what we're trying to show here with either percent previous option volume yesterday, it's looking for that heat map, that increase. So if I only wanted to see options that traded double their average, what would their average be? Well, it'd be 100%, right? Equal to the average over the last 30 days, it'd be 100. If I want that to be double, I'm going to go to 200. So I only want to look for any options that match the other criteria that had an option volume today at least twice as high. Or I could use the previous option volume as well. So let's go ahead and see if there's anything there. Okay, so we have things like ACA, 1-800-Flowers. That's kind of interesting. Rent-A-Center, Eli Lilly, Foot Locker. That makes a lot of sense, doesn't it? There's a lot of movement on Foot Locker today, up and down, so it make a lot of sense of people going in and out of either options they were already in with this large gap up to 68 and the pullback to 62. And then some of those pharmaceutical companies we saw here took the big jumps, $11 on Zscaler. There's your Tandem, up 367 there. Farfetch Limited, 432 on a $28 stock, good move there. So these ones with these higher movements, you can see these are the ones we'd expect to have that increased percentage option volume as well. Okay, there we go. So that's how you can do it. Now, if you want to see a broader range, of course, what you might want to do is clear the settings out. What we're seeing are the options that had the 200% current option volume today that matched our other criteria for stocks being above the 20-day moving average, up in the higher range of the upper Bollinger Band, greater than 60% of the 52-week high to match that default Bollinger Band screen that you can use as a stepping stone. We did find 15 positions that had that 200% increase in option volume across the board. All expirations and all strike prices. That's really what you're looking for. Some people might buy near in or sell near in. Others might be buying further out. So you want to see the whole gambit of the strikes and see what's really increasing across all expirations and all strikes, because different investors have different plays, but that's where the activity is. That's where the money's going to. You want to go higher? No problem. See if there's anything that's at the 300% range for option volume today. Take out 5 of them, but Foot Locker, as we kind of would expect, that big move on Zscaler, expect that too. Teradata across Rent-A-Center and Eli Lilly, they're all there as well. All right. Okay, so that's the filter that you want to use to look for an increase in option volume. You can use either the percent previous option volume, Mitch, or the percent current option volume as well. Okay, Sam says he's looking still at CGC and Kronos. They're still looking good. Those are some of the pot stocks. And he says AMD as well. I haven't checked out AMD in a few weeks. Let's just look here. Okay, so it's at 2368. It's about where we've seen it. Yeah, so it had that pullback with everything else in October and November. Bottomed out about, what, 1550 or so, I guess, in December. Not quite doubled yet, but it's a good return since that bottom out with the market on, what was it, December 26th, December 27th, when everything else started to pull back. So it has recovered nicely, but it's still 12 points down from its most recent high in September. Okay, so it's looking better, as you mentioned. Hard to tell where the resistance would be on this one, as it's peaking at 25 and then pulling off of it. So really got to see something that breaks through there. The next earnings, of course, we just had it recently. So the next expected earnings around April 24th or so, about 3 months away. Might be a consideration for a married put position for me if this continues to move up, if it matches that criteria. Okay. All right. Okay, Jim, not John, Jim asked a question. He said, I'm having trouble deciding which, this is a tougher question, I thought. Jim says, I'm having trouble deciding which option strategies I should start trading. I'm newer to options. I'm learning different strategies, but I've yet to pull the trigger. Okay. Well, I'm trying to think of where I want to start this. Jim, here's what I'm going to say to you. If you're having trouble pulling the trigger, it's because you have fear that you're not sure if the market is going to continue doing what it has, where it looks like a neutral to bullish or bullish strategy would work well, something akin to a covered call or naked put. Maybe even a bull put credit spread, maybe even a calendar spread. You're hesitant on it because you think if the something goes wrong and the market pulls back, you're risking too much to make the profits you want. Okay, and that's very common. Let me just go to the basic search for the covered call. I'm going to look at the initial value screen, Jim. And this is one of the searches that looks out about 25 to 30 days out in time. I'm not going to worry about the picks of the day. I'm just going to look at the at-the-money initial value screen. Stitch Fix has been all over the place. Is there a good stock? Celgene, a little bit more expensive, had a good move today. It's got a good return for a 48-day standard April expiration. All right, let's take the Celgene position. This is not a recommendation or a suggestion. So where I was going with this, Jim, is you might be looking at some of the basic strategies. As you mentioned, you're just kind of getting started. You're learning some of these strategies. You've got a good idea, but you haven't pulled the trigger yet, because you don't have the confidence in the strategy or on the stock that you're looking at. Oh, remember, one thing I'm going to encourage you to do is schedule a coaching session next week with myself or Ernie. We'll show you how to use the tools to structure a trade where you'll feel more confident in your selection based on what we would consider looking at for the technicals, the fundamentals, the return, and protection. This covered call, it's 48 days out in time, a little bit longer than I'd normally go for a strategy of this type. But we are buying Celgene at $85.96. We could get almost $7 for selling the April 85 call. Now that gives you about a 7.6% return if assigned for 48 days. That's a good target. You know, usually about 20 to 30 days out in time, I'm trying to look for a 2 to 3% return. So we're there with Celgene. I don't think we had earnings coming up between now and expiration. It might have been today. Let me take a look. Oh, yeah, next earnings is 5/3. Okay, so we've got about 3 months to go. It came out in early February. That's important to note, but I would have had that set in the search already to not show me any stocks for this strategy or a bull spread, a naked put even, that have earnings between now and expiration. Okay. So you might be considering something like this, maybe not even this high, but you're also saying to yourself, look, the market's been weird. We saw 3 months of what we didn't want to see for neutral to bullish strategies at the end of last year, October, November, December. We've been going strong since then. This gives you a good $7 downside protection. What does that mean? It means your break-even is $79.01. The stock can roughly fall 7 points before you technically be losing money on the position. Okay? There we go. So in that case, where am I going with this? You're not happy with this. Okay, you're not confident with this. Not happy. We'd be very happy with this return. Might not be confident with this, Jim, because you're worried about this, and that's a flaw with the covered call. Or if I was in a bull put spread where I was looking to make maybe 50 cents on a 5-point spread, so my risk would be 450. That's a 9-to-1 risk-reward ratio, and if the stock fell and did drop, not below 58 in this case, but it'd be a 5-point spread. So let's say I sold the 80 and bought the 75. But if there was another in the next 10 to 15 days, another movement as we saw towards the end of April, to the end of October, beginning of October, end of November, and end of December, you might be below this put strike price and realize the full loss of 450, which might wipe out 9 previous trades. Okay, so where I'm going with this is it's not so much about you not knowing the strategy. There's reason to be concerned with the market, and that's commendable. You should always be worried about it, and if a trade that you're considering entering doesn't feel right, fortune favors the bold, as they say, but the bold also go broke over time. So what I would consider is instead of doing something, maybe this structure, a covered call that has this risk, or a bull put that I use in my account and I look to be profitable with, but it does have that 8-to-1, 9-to-1 risk-reward ratio, which you might consider here as something a little bit different, something to give you a little bit more safety and a little bit more ease of relaxation and confidence in the trade. If you're considering a covered call, I'd consider doing this as a collar. You're taking a really good premium here, even slightly in the money. But what I do to create the collar then is I'd go out to April, selling this 85 call, which would be 7%. I'm going to take some of that profit off the table and maybe buy an 80 put. It's a wide bid-ask spread. I don't like that, but I might buy the 80 put here, and let's see what we get. Now remember, this is 48 days out in time. I still want to make about 2% return every 20 to 40 days, about every 30 days, and this is right on it. So I cut the risk in half. I cut the max profit in half, more than half, down to only 3.5% for 48 days. Why? That even in the worst case scenario, if the stock plummets to $70 per share, I can't lose more than 2.6%. Yes, I want to win. Yes, I want to have a winning track record. But if you're not being able to pull the trigger because you're concerned, you don't trust yourself, it's not so much you don't trust yourself, it's you don't trust the structure of the trade. The covered calls, the naked puts leave that downside open. As I mentioned, I trade bull puts and I've been successful with them, but I know going in what risk reward I'm carrying and what triggers I need to manage it. If you're looking for a 20 to 30 day out trade for income such as a covered call, look to convert it to a collar. Cut that risk down. Yes, you give up some of the return, but this will still probably meet your goals. And I could do better than this. The 80, as I mentioned, that bid-ask spread was wide, and I knew that was wide when I looked at it. I'm probably more apt to go with that 75 strike. I'd love a 77.50. But only 260, it's 5 points lower, so that's going to increase my risk. But remember, this is a guaranteed exit, unlike a stop order. If Celgene fell 15 to 20%, I had a 7% stop order in place, what happens? That's a market order. It falls 15%, the market order gets triggered, I take the 15% loss, not the 7%. This is a little bit higher than I want, but it does give me only a 2-to-1 risk-reward ratio. I'm looking to make 4.2% if Celgene stays above 85, with only risking 8.1%. The other one might be better, 3.5 to 2.6, but that depends on your personal risk-reward tolerance, Jim. Earlier we talked about the married put position. If you're buying stocks that you want to hold long-term, or you're trying to do a monthly covered call on a stock that you want to do long-term, I'm going to suggest don't do the covered call yet because you're worried and you haven't pulled the trigger. Consider following the basic structure of a radioactive trades. Instead of selling a near-term call, how about buy a far-out put? Now, it's going to be expensive, but cost per day, this put is going to be less expensive than trying to buy a 1-month output month by month by month by month. I think this risk is going to be too high. I'm probably going to stick with the 90. Okay, so if I opened a radioactive trade on Celgene today, I'm likely buying the shares of stock at 85.96, probably buying the 90 put for the midpoint of around $10.10 or so, 10.03. Yeah, this gives me that 230 some odd day protection with only a 6.2% risk in the absolute worst case scenario. Now, I'm not going to get as much premium, but if I wanted to, I'm just going to go 35 days out. I could cut some of that down by selling the 90 call right now. These bid-ask spreads are very high. Something's going on with the stock I got to take a look at. I'm not going to get that 311. I'm probably going to get 260 or so for this. That bid-ask spread is way too wide. But in any case here, what did I just do? Now I cut the risk down to 3.6%, and I have the potential to make 4.5. But remember, at April expiration, if the stock's below 90, this expires, I still have an October put. I still have 200 days out in time. And worst case scenario now is I can only lose 3.6%. If you're feeling that you want to be opening trades right now, but you don't have the confidence to open them because you're worried about the market, I can understand that again. It's good to worry about the market, but you're worried about pulling the trigger on a trade because of the structure of the trade, and if that worry of the market comes to fruition, you're going to suffer large losses. Look to those conservative strategies. The long collar, more importantly, the married put position as talked about in the blueprint RadioActiveTrading.com to put time on your side with insurance, leaving the upside open, but still having the ability to do other adjustments there as well. Raheem, okay, I was just going to ask this question. Raheem says, does PowerOptions include risk reversals in its strategies? Not as a direct search and not as a direct management view inside the portfolio. There are ways you can evaluate that using the different tools manually. We covered this maybe in September or October, Raheem. I can't remember when we did it. I was asked a question about this, and we nailed it down to what the attendee at the time was asking about the risk reversals and what they were looking for. We showed how to use one of the manual tools to do that. But as a separate search structure, as a link to manage a position and evaluate risk reversals, it's not there. So what I'll do is I'm going to go back through the archives and see where I talked about the risk reversals, and I'll send you the link to that webinar that we did before. But to answer your question, it's not a direct tool, and it's not something that appears directly inside the position analysis view and the rollout opportunities of the portfolio. Okay, Frank, great question based on what you've seen so far, and I can understand it. Frank says, does PowerOptions work for 2 to 3 week strategies or just for 2 to 3 months? We show everything. Okay, as I mentioned at the beginning of the presentation in our opening slides, PowerOptions is designed to be a one-stop shop for self-directed options investors. It just so happens that the questions that have come in so far today were related, Frank, to the married put positions, the straddles, a little bit of diagonal spreads. I've been talking about the bull puts here, okay, and that yes, I trade bull puts. That we've done presentations on them. Some of you've probably seen them. This one here is showing positions that are 48 days out of time. Well, that's because it's the default search. If you wanted to open bull put spreads that were 30 days out with high probability and high return, this is the search you would use. I've got other saved searches in here. I apologize. I'm going to go to the weekly bull puts one. This is the one that I use in my personal account. This is the one we did presentations on going through January. We support all options. You can search for options that expired this week. You can search for options that expire in 7 days. If you're trading SPY or SPX, you can screen for the options that expire on Monday or Wednesday or Friday, every 2 days apart now. Now, this is 14 days away, 2 to 3 weeks out, as you mentioned. This is my preferred bull put credit spread search. Why 14 days? Because when I did the testing, I found that going 14 days out in time with the proper probability range outperformed positions going 5 days or 7 days out in time. Now, you'd think that you'd get a higher annualized return, but remember, when you're doing a 1 week out spread, you are going to get a lower net credit, which means your risk-reward tolerance is exactly the same. So instead of the trade desk position here, buying the 170, selling the 177.50 bull put, let's look at the graph. That'll be better, right? I mean, much easier to see. So here we'd sell to open that 177.50 put for about $1.13. And I'd buy a 175 put for 80. Because of the criteria I had set in there, looking for the time frame of only 2 weeks out in time, this position has an 85% probability or higher of expiring worthless. And the short option delta is less than 0.2, probably less than 0.15. Okay, it's still a 14.7% yield for 14 days against the margin requirement. The difference in strike prices minus the net credit. Well, where am I going with this? So let's say that this does go against me for the full loss on this position. All right, so let's just say we took in 33 cents, maybe, okay, 32 cents, I'm sorry, and it is a 2-point spread. All right, so what is this? 32 cents to 2 points, we're looking at about a 6-to-1, 7-to-1 risk-reward ratio. It's closer to 6-to-1 than it is to 7-to-1. Okay, so if this did suddenly for no reason drop from 195 to 175 in the next 14 days, and I took the maximum loss of 218, that's really a true risk, really. I'm sorry, it's 218. It's 250 spread, not a 2. My apologies. So 218 there, that is, we're going to call that 7-to-1. Yeah, we're going to put that at 7-to-1 risk-reward ratio. So I do take the max loss, Frank. I just wiped out 7 previous gains. If I did a weekly with these same strikes, my net credit is going to be maybe half of this, maybe 18 cents. That makes my full loss 232. 18 over 232 is a 11-to-1, 12-to-1 risk-reward ratio. I lose this because it suddenly moves against me. Yeah, it's got a full drop far in 7 days, but I just wiped out 12 previous trades. All the testing I did with a 7-day out, you still experience losses. We set stops to only get out at never take the full loss if possible. And the 2-week out still performed the 1-week out. Okay, so we support all that. Whether you want to do iron condors, I don't advise it, but I do have some customers who are buying calls and buying puts on Monday that expire that Friday, hoping for a quick return. I don't think it gives you enough time and that you end up seeing more losers than winners. But you could do that as well. In any strategy, Frank, you can set this expiration time frame to anything you want. I could just look for standard March expiration, standard April. I can look all expirations and set it to be 0 to 8, just to look 1 week out. Or I could say show me only positions that expire in the next 2 to 21 days. So any weekly expiration that matches my other criteria would appear. We'll see things mostly that are going to be closer to 20, 21 days out in time at the top because they're at the highest return. That's how I'm sorting this result. But we'll see the 14 days, 7, 7, 14, 14. So there's a mix here of the 7s and the 14s. You can structure it any way you want to. We support default searches in most of the strategies if you want to look 1 month out. Sorry about that. If you want to look 1 month out, if you want to look for weeklies, if you want to look at particular sample searches as well. Okay, so that's all available for you on PowerOptions, Frank, regardless of your time frame. And hey, same thing. If you wanted to sell options, covered calls that are 6 to 8 months out in time, we could do that too. You know, you could set up a covered call search to go out in time. All right. Well, Raheem says he'll search for it too. Raheem, it was one of these Friday sessions, and it was from last year, and I might have taken it down. So when I said I'm going to search for it, I'm going to jump onto YouTube there, and I'm going to search for it on my fields as the creator because I could do different searches. I think that you can. So the requested topics is where we put our Friday sessions. And as you can see, I left some, but I cut off a lot of the ones that happened into November. I'm sorry, into the end of 2018. So it's still, I still have a recording of it. It's still probably on YouTube there. But you see, notice there's a gap here from May to August, right? So there were a lot of ones that were similar. So I cropped those out and kept the ones that were new in there. So I'll look for that. You can look if you want, and if you find it, fantastic. But Raheem, I'm going to look for that one for you, see if I can find it as well. I'm scrolling just by luck if I catch it, and I don't think I'm going to catch it because I think it was older. It wasn't in the last few weeks. Okay. So that's how you can access our webinars as well, just on the webinars link. Okay, let me see where we are here. All right. Okay, and Sam brings up another point, and this might have been one of the reasons why Jim had mentioned the fear. Sam, I'm not sure. Sam says, I want to tell Jim that you're going to have losses in the market. That's a good point. They're going to happen. I trade the bull puts, as I mentioned, with that 8-to-1 risk-reward ratio, knowing I'm going to take losses, but as long as I keep my win percentage where I want, 87, 88% of the time, and I cut my losses, as Sam is mentioning, cut them early. Don't let your losses go bigger, and don't let them go to the full loss on one of those vertical spreads. You're still going to be profitable. Jim's fear might be that he doesn't know exactly where to set the stops on those kind of strategies he's looking at, and that's another reason why you might want to schedule that coaching session, Jim, and you and Ernie or you and I can talk about it during the coaching session as well. All right. Whew. Deep breath here because Mark's got a long question. I know we're right about 5:30, but it's a long question. I think it's going to be a longer answer. Or maybe not. All right. Mark says, I'm challenged in doing calendar spreads, calendars. All right, so let's make sure I've got calendars up here. I do not. Let's add that back in place of our long call. So I'm going to just do calendar calls. What is a calendar call? For those of you that don't know, a calendar call typically consists of buying a call or buying a put, that is a few months, a few weeks, usually a few months at a time, 2 to 3 months at a time, and selling a near-term call against it. Some might say it's similar to a synthetic covered call or the poor man's covered call. I don't like that term because if the stock falls 10%, you might be losing 40 to 50% on the diagonal spread due to the leverage. You have to keep that in mind. So saying it's a poor man's covered call, they say you're simulating the long call for the stock, but remember the long call is leverage, and leverage works both ways. So you could be at 50 to 60% loss on that spread very quickly. So those of you who are not sure what we're talking about, that's the calendar spread. Anyway, let's get back to the main question. All right, because of the current declining volatility environment, down to about 1350 right now on the volatility index. Might be time to buy calls on the VIX if we're expecting a change in the market with these lower prices. Okay. Might you have any similar balanced trade strategies for me to consider in the current 60-day now declining volatility market or other perspectives and approaches? Okay, well, volatility is declining because the market's going up and things are calming down until the next thing comes out. Okay, so there's risk in all that that's inherent. This is the game we play, unfortunately. So we've seen a lot of volatility. Go back here. I won't pull up a chart on the VIX yet, but let's just look at SPY. As we see, oh, that's the 1 year. I want the 3 month. Okay. That's not far enough back. 6 months. My apologies. All right. This is why volatility increased from October 5th to December 16th. This is why volatility is decreasing, because everything has calmed down. Hasn't been a lot of big major news, saber rattling, although the Pakistan and India thing is always something to keep in the back of our minds with trades. So the diagonal spreads were working well for Mark during this time period. Why? Because he was buying calls that were maybe out in April or May or maybe even February or March. And he was selling possibly at the end of this, maybe some December out of the money calls, then some January, but the volatility is slightly falling, then a little bit more, then a little bit more. So now what is he doing? He's not getting enough premium here because volatility is down. The volatility on his FAR options might have decreased also from when he got in, and he might be losing money because the volatilities on the FAR options are decreasing also. And so he's not getting enough premium here, and he's watching his costs decrease as well for those long ones. So is there an answer? Well, I don't have a great answer for you, Mark. Might you have any similar balanced trade strategies for me to consider in the current 60-day now declining volatility? Have you considered double diagonals to sort of increase the return? You increase the cost, but you're going to increase the premium as well. So I might go into, let's say, a diagonal spread, buying, sorry, let me try my weekly diagonal search. There we go. All right, so selling something 7 days out, buying something 48, 42, 45 day out. This one we know has high volatility because it had that big pop today, or relative pop today. I don't know what's really neutral here. Let's just take GPC. I'm not going to take GPC. I don't like the numbers. It's weird, 110, 103. I like to be basic. So I'm going to stay with Eli Lilly. But it does have good volatility, so this is part of another problem. Here we are with this diagonal spread. When I do a diagonal spread, everyone keep in mind what I really want is the stock to be trading right here. I'm okay if it moves up a little bit on this structure because I'm still in a profit zone, but naturally here's the loss, and look at the loss. Right? It's 868, so I'm still at a 4-to-1 risk-reward ratio. My cost was 868. I can lose 100% of that if the stock, say, fell 15%. Right? It drops down 15% to about 103, 105. This 110 call might lose most of this value very rapidly. Okay. When you're in something like a bull put spread and the market is moving up gradually and your volatility is declining, so you're not seeing the same returns you wanted, you could increase the bump by adding a further out of the money bear call spread to create an iron condor. What you may consider here with a calendar spread, I don't know your time frames, Mark, I don't need to, but you could do almost the same structure here, but I would do it a little bit differently. But you could almost do the same structure here in a market that's gradually moving north and has been consistent with that for about 45 days, and volatility is declining by doing the opposite at the same time. So remember here, I'm buying an in-the-money 120 call, a few points in the money, and selling an at-the-money 130 call. Now what I might consider doing is, what can I get now if I buy, oh, I'm sorry, and it was March 8th to April 18th. So what if I buy an April 135 put and sell the March 8th, 7 days away, maybe 120, that's only 30 or 40 cents. So let's go with no, I'm sticking with the 125. Okay, I'm trying to keep the numbers the same. This isn't really the structure I would use. I just want to show it real quick. I want to get more premium than what I'm getting here. The cost isn't bad. Nah, it's too close. I'm sorry, that is too close. I'd have to move this up a little bit, change this position a little. It does give you 2 ways to lose now. That's the negative, but you could get a little bit of premium. Another idea is, instead of adding this calendar put to create what's called the double diagonal, is shorter term and increase the risk, but maybe I could go a little bit further out. No, this is a bad example because the bid-ask spreads are ridiculous. A little bit better. Okay, so one other thing I could do is add maybe a bear call credit spread inside this structure. Gives me a little bit more premium, gives me a little bit more return. Unfortunately, it does increase my risk. But I went far enough out of the money, hopefully, by selling the 135 call, again, for 2 weeks out, because the 1 week out didn't look that good with the bid-ask spreads. But adding this bear call spread, it does add 5 points. It does cap the upside. But remember what we're talking about. We're talking about a market that's doing this gradually. It's not rocketing up and rocketing down and rocketing up and rocketing down. It's gradually going up, 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 which is going to kill volatility. Again, we're down at 1370 or so, 1365 on the VIX, which we haven't seen in a long time. That's why I mentioned, again, maybe it's time to buy some calls on the VIX, maybe 2 months out. So if there is a sudden decline, well, you would have lost on the calendar spread anyway. You hedge some of it by the extra premium that you get with the bear call. You do cap the upside, but again, we're talking about a market that's gradually moving up, not rocketing up, so you would be able to potentially manage this short call before it got into trouble. So I'm not telling you to change strategies, but what are good strategies that have controlled risk for this subtle market with or without high volatility? Standard collars, I know you got to end up buying the stock. Bull put spreads, you can still get the good leveraged return, but you are taking a 6-to-1, 7-to-1 risk-reward ratio. You could stay with the strategy you're already using, but just maybe enhance it. I'm not saying you have to do a bear call spread. I'm just offering ideas that you could take your one idea. You're not making the return you want because of the volatility. What might be unfortunate, again, Mark, for your position is you might have entered this spread a month ago when you bought the April 120 call, which now might have lost value because its volatility has declined from where it was in December or at the beginning of January, and that's tough. But there might be ways to structure different trades there to get that to you, to get that extra premium, to get back to where your target goal was in the calendar spreads you're not seeing now with the volatility falling. And the volatility, as you mentioned, is likely affecting things like SPY the most. SPX, right? Those are the ones that are going to see the volatility affect faster because the market doesn't want to see indexes and ETFs with high volatility. So as the market starts to settle, the broad-based indexes might be the ones that you start to see have the first effects faster, where some stocks are still bouncing around and keeping some of the volatility. I'm not telling you, Mark, you necessarily need to change your trading plan and move away from SPY. I'm saying if you're going to stick with SPY, but you're not getting the premiums now because the volatility has dropped, you may look to augment that with another strategy that doesn't take on too much risk. You might be able to add a vertical spread or add another diagonal spread opposite to create the double diagonal to push up those max returns a little bit and more. Yeah, as I mentioned, I would structure that particular double diagonal differently. I wouldn't do it necessarily in that fashion where that short put was too close as well. All right, let's see here where we are. Okay. All right. Oh, another suggestion for Jim, of course, is to paper trade. You could paper trade using the PowerOptions portfolio to get more confidence in these strategies we're talking about as well. Okay. All right. Oh, Mark, you're welcome. Let's see here. I got John question. John? Yeah. John. Okay, good. John says, I bought the blueprint a while ago, but haven't used the system. Regardless of the strategy, they are all dependent on the ability to pick a stock's direction. That's the bottom line. Yeah. Okay. I'm saying yeah. I didn't mean to sound facetious in that, John. Yes, the married put is a bullish strategy. I want to pick stocks that are neutral to bullish. We've set the criteria up here to look for stocks that match our neutral to bullish criteria. I test them every year. Let me see. I'm John. I got to write down a note here for you. In addition to, I've got Raheem here. Yeah, there's Raheem's note. John, writing down this note in relation to your question as far as stock selection goes. The reason why I mention that is during the December webinar series on radioactive trading and radioactive trading techniques, I talked about my return record for last year. Not on the married puts. I think I shared that too. But what I did is I went back and grabbed the top 3 results that matched our default radioactive sort and tracked them for 3 months, no income methods, okay? And then the next month I grabbed the next 3, next month I grabbed the next 3. And I believe it was somewhere in the range of 71% of the time. The stocks from this list, even last year, remember, 2018, 6 out of the 12 months showed negative performance. 6 out of the 12 months were negative. I think it was 71% of the time. Those top 3 trades I found at the beginning of each month using this default search were up the 3 to 5% in the first 20 days, which is my target goal for the RPM. I want to select a stock that I feel has the confidence to move up 3 to 5% in the first 30 days or so. And that's when I'm going to look to apply an income method. It's right 71% of the time. What's the advantage? The ones that didn't stagnated or fell a little bit, and in the case of opening 3 married puts on February 5th, or the beginning of February, my apologies, John, and then that volatility crash happened, the volatility spike happened, and everything crashed there February 5th through 9th. Well, unfortunately, in the first 10 days, all those positions were down. Couldn't have been avoided. But you know what? The maximum risk on those 3 positions that would have opened was an average of 2.8%. Whereas if I'd done a covered call on those same 3 stocks, a bull put credit spread, a naked put, well, the bull put and the covered calls would have been down 7% for a 1-month trade, even though you collected premium. Mary puts were only down 2.3%. And the bull put spread, the losses I did take in my portfolio on 3 trades, wiped out 2 previous months of work. Okay? And so where I'm going with that is that it's dependent on doing that. We've put in the blueprint what we use for stock selection. I'm going to have something in a week or 2 for blueprint owners. It's going to be a shorter presentation, but it's going to go in depth into my process for selecting stocks. And there's already other webinars on that are available. But here's why I do that. Why did I do that? Because then I went back and I did this same search, but against S&P 5-star stocks, stocks in the NASDAQ 100, vector vest stocks, things of that nature. Because what I look to do is see, are the criteria that we have up here, are they performing as well as we expected and as what we want to do? And if I find that the S&P 5-star stocks performed better with that same type of selection, matching the same criteria for married put, we would change and update this. Guess what? It didn't. Okay. So that's to try to give you some confidence as to the criteria that are coming in here, how they're found. Mine was at the same target. 72, actually I think it was 78% roughly. I can't remember the exact number. It was 8 out of 9. Sorry, 8 out of 9 trades. You could count it as 9 out of 11. Depending on where you wanted to set the fence for the trades I opened in 2018. But the 7 out of 9 or 9 out of 11 did go up the 3 to 5% in the first 30 days I expected, and all of those were taken right from this list. Okay, they were taken right here. Okay. Oh, okay, and you said trading $85 or $100 stocks requires a pretty large account. Yes, now I do have some. The most recent one I opened was in the $76 range. NRG you saw, I think if you were here, John, at the beginning presentation, that was in the $40 range. There are some subtle changes I make to this list for my personal account. The first thing I do is I show positions between about 3.5%, to 8%. That's the max risk I'm willing to take. I don't let it go up to 9. Just like you, that's a default, right? It's just a stepping stone. You want to customize this to your needs. Mine's usually at 75. Now that I've got 3 or 4 positions open, the max I can do on the next 2 or 3 trades I'd open is probably going to be 55 or 50. And that's perfectly fine because I still have trades here that will still match that $42. There's NRG I'm already in. Don't know Neogenomics, $22 stock, CN at 42. Ernie just opened that RPM last week. Kirkland Gold, I've been looking at that one. Now might be a buy time. I'll have to see. Yeah, I was looking at it when it was at 37. Ally Financial is in there. Okay, so I'm just pulling out names now, but that's what I look for, and that's what we look to accomplish. I'm going to have something for all blueprint owners next week. It's going to be a members-only pre-recorded presentation on more thoughts on stock selection. This question did come up as well. It's a great question, John, and I appreciate it. But I wanted to assure you that I'm going in the background here. I am testing these to make sure that they still work and they're still matching what we're telling you that we want to find. Okay? Now, I made a comment or a little noise earlier that I said I didn't want to be facetious because your comment was, regardless of the strategy, they are all dependent on the ability to pick stock's direction. Pretty much every strategy is. Covered calls. Even if you're in the money, you need the stock to stay the same or move. If it moves down, this is why people gravitate away from covered calls to things like the radioactive technique and the married put, because you don't have the protection there. Naked puts. I can go 7-8% out of the money on a 30-day trade. But it still has the same exact risk-reward profile. If the stock just starts to fall, it goes down 5%, then 7%, then 3%, then 2%, I'm at a 10% loss, even starting off 7-8% out of the money. Okay, that's not what I can take because remember, here I'm only making 1% for a 2-week out trade, maybe 3% for a monthly, so it does hedge if I take a 10 or 15% loss, but there's no protection. Vertical spreads, yeah, I can go out of the money with my bull puts as I do. And I can look for probabilities of 85% or higher that the positions are going to expire worthless. And I match that. All right, I've been getting that. If I was only getting 80% or 78% success, I wouldn't be profitable based on my structure. So even though I'm out of the money, I am going to take losses, as Sam mentioned earlier, in any strategy. So even the iron condor, why am I showing all this, John? I'm showing you this because every strategy is dependent on picking the right stock. And you can say in the last, you could easily go back. We can nitpick. You can go back and say, you know what, Mike, I bet you any amount of money, small or large, $1 to $1 million. Mike, I bet you my slightly in the money covered call portfolio from December 28th to today is beating whatever you're doing in the married put portfolio. And you're probably right. You know why? Look at the market. This is exactly what you want for covered calls, naked puts, bull put credit spreads. My bull put credit spreads might beat your covered call portfolio. I don't know. Percentage-wise, not monetarily. But see, that's what we're talking about. This is what you want. This is when those strategies work. This is the worst environment for a covered call, naked put, bull put credit spread, calendar spread, anything that's neutral to bullish. You know what these two cycles are also sort of a bad time for? This was a terrible time for iron condors, and this is looking like a terrible time for iron condors. You don't want a 40-point movement in 2 months on an index when you're doing iron condors. Even if you're going 1 week or 2 weeks out in time, you want this. You want something that's ranging between 270 and 250 and not moving. Okay? So I made that comment because every options strategy is dependent on having the right cycle in the right time. I don't trade iron condors anymore. I haven't. Ernie hasn't. I haven't since probably 2015. I've traded bull puts. I've traded bear calls. I don't combine them anymore. Why? Let's go back 4 years on our chart, shall we? Just as I said, from 2016 on, this, if you picked it right, was a good time to do iron condors. This was the time to be doing iron condors. This is not, because you're managing the bear call side consistently. And you're taking losses here, where if you just did the bull puts, profit, 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 profit. Yeah, there's some hiccups in there, I know. This is not the time for iron condors, probably not the time for bull puts or bear calls, probably the time for long straddles, long strangles, things of that nature. This is not iron condors, that's bull puts. This was, think about it, this was 2018. This is that 6 months of negative and 6 months of positive market performance. 2018 was not a great time for iron condors. You got hurt February, March 21st to April 5th. Then again, there was a hiccup in June. Then October, November, December. There was a good middle run in 2000. Oh, I'm sorry. That's just the last 3 months. This was the good middle run only. This section here in 2018 that might have been good for iron condors, but it was moving up quickly. Okay, but that was a good time. You would have lost money in the first 3 months and the last 3 months on iron condors, and significantly. And then again, here we go. Does that look like it's something for iron condors? No, this is. This was. Maybe this cycle in here was. I'm just showing you this because this was the last time I traded iron condors. Or no, here. This was the last time I traded iron condors or looked at them. I'm pretty sure that's the last time Ernie did or even tried to convert a bull put into a bear call. I'm sorry, add a bear call onto a bull put to leg into the iron condor. This was not the time. I did not do iron condors or even discuss them, even do webinars on them from 2016 to now. And I don't think this is the time for iron condors either. It's moving too much. So I'm just bringing that up because, yes, I want neutral to bullish stocks in the married put techniques. That's what I'm looking for. That's why Ernie and I have, used that search criteria we have been using since we got connected with Kurt back in 2007. And I go back and test it. I evaluate it. And if I see anything that needs to be adjusted, I will adjust, and I'll let all Blueprint owners and radioactive traders know. I do that with the other strategies too. I've been doing the bull puts. Ernie's been doing the naked puts and the covered calls with the picks of the day features and power options and more. But you don't see us talk a lot about iron condors because it doesn't look like the right time. It hasn't looked like the right time for us in almost 4 years, a little bit over 4 years. So, are there completely neutral strategies that aren't dependent on stock movement? Well, one can argue that the long straddle or a long strangle where you're buying a call and a put, doesn't matter where the stock goes, you're going to make money. Yeah, that's tricky to state because you still have an upper and lower break even. The stock needs to move enough one direction or the other to counter the cost of the long call and the long put so that you have a profit. Because remember, one's going to zero as one's increasing. You got to cover the other cost. If you do a strangle where you're out of the money on both options, you need that movement to get between the two, right? So let's just review. Long strangle. That's where I'm expecting a movement upwards or downwards. I don't know what the market's going to do, but I'm buying an out-of-the-money call and an out-of-the-money put, and let's say stock's right here. I'm equidistant at the time. Well, as long as the stock moves one direction or the other, I make money. No. If this cost me $2, let's say I went out 2 months. This put cost me, the out-of-the-money call cost me $2, and this cost me $1.80. Doesn't matter the strikes. Right now, I need this to move $3.80 above the call or $3.80 below the put to break even. That's in addition to the sideways movement to get to the put or the call strike price. So I might need a $5 or $6 movement one direction or the other, depending on how you structure it, to get to a profit. So you can say, oh, this is neutral and you don't care what the stock does. As long as it moves one way or the other, you're making money. Well, as long as it moves one way or the other quickly enough to where the deltas, where you start off, remember, you're not delta neutral, you're delta opposed in this scenario. And by the way, selling a short strangle and saying that, oh, as long as the stock stays in this range, you'll make a profit. Again, this is why I stopped doing iron condors, because this market's doing this. You'd have to be adjusting the short call side consistently, paying more than you collected it for, wiping out the gains from both legs without, as Sam mentioned earlier, strict management involved. So yes, one last time, related to the married put, I do want a specific type of stock. I try to look for stocks that I feel have the opportunity, the chance to move up 3 to 5% in the next 20 to 30 days. I'm not always right, but that's why I have the put in place to begin with in this strategy. We check the criteria, we make sure it's still working as we expected. Some positions we lose, but we're only losing 2 to 3% if we don't meet our goals on the position. We don't get the profits we want. We're taking a limited risk. And that's better than a covered call where you're making a limited capped gain on the upside where you might be losing 3 to 4 times as much. With the married put, on the ones that are winning, I'm likely making 3 to 4 times the amount that I'm taking on the losers. Or at least 2 to 3 times. So what does that mean? That means I can be wrong more often than right and still make money. That's not the goal. And that's not my history, the track record there, okay? But that's the married put is the only strategy I know of where, yes, we want bullish stocks, of course, but by the structure of the trade. You can actually have a 50-50 win-loss ratio and over time still make money. You can't do that in covered calls. Okay, you can't do that with long call trading. You can't do that with, I don't want to say you can probably do it maybe with straddles around earnings or strangles around earnings that Ernie talks about with his earnings approach there in the straddle and strangle sessions. Can't do it with collars even. Long collars that, you know, I usually like to trade and we've talked about, because we saw earlier when we broke down that collar that we would likely use to keep the 4% profit on Celgene, we were taking 8% risk. If I'm risking 8% to make 4, and by the way, my collars, I'm usually looking for return around 2.5, but risking 4% is just the basic end game structure. I still need to be right 67, 68% of the time in a profit long term. I've been able to get that, so I keep trading those strategies. But again, I can't be right 50% of the time and make money. that's one of the forgiving, extremely forgiving aspects of the married put techniques going forward. And as I said, as related to the stock selection, I'll have a little bit more of a blurb for you in the next week or so as well. All right, well, ladies and gentlemen, I don't see any other questions that have come in. I just want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Now, any stocks or options discussed today should not be taken as direct trading suggestions. Options do involve risk and may not be suitable for all investors. If you'd like some of the tools that you saw today, the use of the portfolio we looked at a little bit, using some of the search functions with that % option volume and the various other stock and option criteria. Remember, you can take a trial at any time. Just go to PowerOp.com, put in your first name, last name, and email address. You'll have full use of the site for 14 days. After the 14-day trial, subscriptions usually start at as low as $40 per month. The most popular 20-minute delayed service is $60 per month, but we do offer real-time and historical as well, where our historical options data goes back to April of 2006. All right, some other free education. Remember, you can go to our blog at any time, blog.powerop.com. You can also check out our webinars page. We showed it today. You can click the Home tab on Power Options, click on Free Webinars, or just navigate to powerop.com/webinars.asp. It's a public page. You don't need to be logged in to view some of the archived material. Of course, you can always follow us on YouTube. Just go to YouTube, look for Power Options. A lot of our presentations are there and public. If you think of any other questions that you didn't get to ask today, or you think of something at any time, including over the weekend, send us an email anytime to support@powerop.com. Remember, if you want to discuss radioactive trading or the blueprint concepts, limited risk with the 12 different income methods and adjustments that we use, just go to support@radioactivetrading.com. Send me an email there. We can also call us during market hours, 302-992-7971. And as I mentioned twice, I believe for Jim earlier, and even Mitch as well, but anyone, trial members and subscribers, schedule the coaching session. Just click on free coaching on Power Options, schedule a time that matches your convenience. Coaching session is typically a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right. All right, John, thank you. I'm glad you enjoyed that discussion. Thank you for the great question. I appreciate it, and it's always good to review that. And as I mentioned, another Blueprint owner asked me that question earlier this week, so I started putting together some material. I'll have that hopefully for you early next week as well. In addition to this webinar archive, this will be posted and you'll receive an email about this presentation when the recording is available. All right. Once again, ladies and gentlemen, thank you very much for joining me. Thank you for your questions. Everybody have a fantastic weekend. We'll see you on the trading floor next week. Take care, everyone. Good night.